Hey, what's up, everybody? It's your mortgage expert, Brian McCauley here. So you're looking to buy a house in Dallas, Texas, and maybe specifically looking at a condo? Well, there's some new condo guidelines out there that unfortunately don't make things easier on the buyer. But I'm going to share with you today the new secrets, the new rules, the new guidelines, and what to be looking out for whenever you're purchasing a condo. So if you're looking at a condominium in Dallas, stick around. This video is for you. Let's get into it. Listen, the DFW housing market is still doing well. There's a lot of opportunity out there right now for buyers that can really get good deals on properties. What we're starting to see is a lot more people interested in buying condominiums. So condominiums are a different beast. You know, when you buy a property, you can buy either a single family home, you can buy a townhome, you can buy a condominium. Condominium obviously is like an apartment. You've got a big community and project of people all living together. The difference between an apartment and a condominium obviously is an apartment. Most of the time that you rent, it's, zoned residential, whereas a condominium, you've got an entire project, but each individual owner owns each unit. And so what happens when it comes to buying condominiums versus buying a house or a townhome is most of the time when you get a pre-approval, they pre-approve the person, they pre-approve the house or the townhome. All they really care about on the property is really about the value and really about the condition of that specific unit, that specific property, that specific house. But when it comes to buying a condominium, not only do they care about the unit and the value and the condition of the one that you're buying, they care a whole lot about the project. Why? Well, if you think about it, condominium projects, whether it be 10 condos or 100 condos, they're all part of a big community. I call it a beehive. And everything that happens in that beehive and that project affects the people that live there a lot more than if you had a detached single family or a townhome. So what has happened in the past is, lenders want to do some digging, not only on the specific unit that the person is buying, but they want to do digging on the project. They want to make sure that there is no, bad issues, troubles, problems with certain things in the condo project, like the HOA dues. Are they being managed correctly? Do they have the correct insurance? Does the HOA have enough reserves? Is there any deferred maintenance? Is there, lawsuits, things like that? Because what happens is, even if you as the buyer have a great credit score, even if you have great job history, even if you have a large down payment, even if you have any money in the bank, they are going to qualify the property and the condo project just as hard as they qualify the person. So this has always been the case in the past, but the new rules around this is they have really increased the oversight on condominium projects. And so back in the day, depending upon, how much money you're putting down, when they did a review of the entire condo project, you could do what's called a full review, or you can do what's called a limited review. Long story short, a full review just means, hey, there's about 40 questions that we as the lender have to send the HOA. They have to fill out all these questions, and obviously the questions have to be answered correctly. Get a copy of the budget. As long as everything was answered correctly, the budget was good, you're all good. If you put more than 10% down, you can do what's called a limited review. A limited review is, hey, instead of 40 questions, we only need 20 questions. So in the event there was some drama with maybe the condo project, if you didn't have to answer all 40 questions and you only answered 20 questions, maybe the 20 questions still got you to the finish line. But what's happened now lately is that they have changed the condo guidelines. So long story short, that full review versus the limited review, they don't do the limited review anymore. They do the full review, no matter how much money you put down. So they're really digging into making sure that the condo project is healthy. There's been some hardships with condos all across the country where they maybe not built correctly, don't have the proper insurance, a lot of lawsuits. And what they're seeing is these condo projects are not being scrutinized, for lack of a better word, enough up front. And then these buyers are buying these units, these condo projects have problems, and it's causing a domino effect after the fact, and people can't sell them, and they're turning them into rentals, and then they end up, having defaults, and then the HOAs can't pay for stuff, and, fill in the blank. And so they've reset the rules, which is, hey, we need the full condo review, no ifs, ands, or buts. So they're making it harder on, obviously, the buyers. If you're a realtor out there, the most important thing is, hey, if you've got a buyer and you're looking at a condo project, don't wait till you get under contract. Let's say, for instance, we've got a deal going, or I've got a client a lot like you that's pre-approved. They're looking at a condo. Don't get under contract and have, send it to me and say, okay, now let's double check the project and make sure that it's okay if you're looking at a condo project, let me know up front. Hey, we might want to put an offer on this condo project. Can we do some research up front? Always better do the research up front now with these new rules versus going under contract, paying for an inspection, paying for an appraisal, and finding out after the fact that there's some drama with it. So you want to make sure and do the research up front. Part two on condos is you have to figure out exactly all the details and specifics on what's going on with the condo project and get that form filled out. So that form is called an HOA questionnaire. And we usually contact the HOA. They usually have somebody over there like, a president, a treasurer, some type of manager that can fill the form out. Now, the tricky thing about this form is it depends upon the condo project, whether or not they'll do it up front quickly, whether they do it through like an automated portal. But most of the time, just as a side note to obviously all the clients out there, they usually charge a fee. That fee is a buyer fee. It is a non-refundable fee. They will have to fill out all these documents and everything over. And then once we get the documents, obviously we'll share them with you and we'll review them. But that is an expense that you want to make sure and double check up front. Again, not to be the bearer of bad news. I'm always a good cop. I'm always on everyone's side. But too many times I see buyers and realtors go and look at condo projects and they don't do this heavy lifting, this hard work up front. Before they changed the rules, it was easier to maybe navigate some of those questions because a lot of times you would get limited review. And so you only had to ask half the questions. And so if there were problems with the condo project, but you were getting a limited review versus a full review, you only had to answer 20 questions. And so if any of those other 20 questions had problems, you could avoid them. The other major thing about this right now is HOA and the reserves. What I mean by that is every condo project usually has an HOA set up. The HOA is in charge of managing a lot of things with the condo project, insurance and collecting reserves and paying for repairs and all these things. And what we're finding is that these HOA companies sometimes are maybe not managing the money correctly, or maybe they've had too many insurance claims, or maybe too many repairs, and their reserves. And what I mean by reserves, just like when a human being has reserves in a gas tank, nobody wants their gas tank running on E. You want some reserves, aka some extra gas in that tank to make sure that you're okay, you're not going to run out of gas. Just like if somebody has reserves in the bank for their personal funds, nobody wants their bank account drained. They want a little bit of money in there just in case something happens. They've got some reserves and they're all good. The same concept applies whenever they're looking at an HOA. They want to make sure the HOA has anywhere between 10 and 15% reserves. So just in case something were to happen, they have some extra money in there to be able to do any type of repairs, whatever needs to be done, whatever the HOA is required to do. Why does that matter? Well, if the HOA gets low on reserves, and let's say they run out of money, on most condo projects, it's written in the bylaws, it says, hey, if the HOA runs out of reserve money and they need to pump the reserves back up, they usually do one thing. They go back to all the homeowners that are in the condo project and say, hey, everybody, guess what? We're too low on reserves. We need to get our reserve money back up. So here's what we're going to do. Your HOA dues are $300 a month. We're going to increase everybody's HOA dues from $300 a month to maybe $450 a month. And they're going to start collecting $150 a month extra from every single person in that project for who knows how long, sometimes years, until they get the reserves back up. The problem with that is that if you have to gain and gather an extra $150 from everyone in the project, sometimes people in that project don't have the extra $150 to pay the HOAs to get the reserves up. And if they don't have the money, or they maybe do have the money and they got to pay in, it can cause some people, if they're running thin on money, to potentially default on the mortgage. So they're paying extra attention to that. So, the takeaway from this is condos are still great. Condos are a great way to live, but the rules around condos have changed. They've gotten harder. And I just encourage everybody to do all this stuff up front to make sure that if you're doing a traditional loan, a conventional loan, an FHA loan, that obviously you need to meet these requirements up front and do the homework a little early to make sure that we meet the project requirements. So that way we don't get 2 weeks into the transaction, you spent money on inspections, you spent money on appraisals, and come to find out this condo project doesn't meet the new rules. So let's get into, hey, what if I find a condo project and it's amazing, but it doesn't meet these traditional rules? So when it meets the traditional rules, it's what's called a warranty condo. Now it sounds like home warranty, car warranty. It's not the same. It's just a term. It's used in my industry. It's called a warrantable condo. It's an amazing condo and it just doesn't meet the traditional rules. We still have home loan programs that are for non-warrantable condos. They're still great condos. They're still performing. They're still all good. There's nothing really wrong with them. They just don't meet the traditional requirements. So then we default to what's called a non-warrantable condo home loan. The difference of the two, the interest rates are a little bit higher on non-mortgable condos, maybe 1/4 to 0.5%. And then usually the investor or probably cross-country that we're doing the non-warrantable condo with wants a little extra money down. So let's say you could do a condo on a traditional loan for 10% down. If it ends up being non-warrantable, they might want 15% down instead. So the condo is still gettable. You can still buy it, but of course, most people want to do it on a traditional loan because obviously you can do 5 to 10% down. The rate's a little bit more competitive. And so if you're doing it, regardless of what home loan program you want to be on, the takeaway from this is do the homework up front with the HOA, with the condo project, even if you're not making an offer yet, or you're thinking about making an offer, to make sure that you don't go back and forth with all the agents, spend days and nights negotiating terms, price, closing costs, closing dates, all these things, and come to find out there's an issue with the condo project that doesn't meet the traditional rules. And if you don't want to do a non-warrantable condo, you've spent too much time, too much money and energy. And if you lean on us, we'll help you do majority of that work up front to make sure there's no big surprises after the fact. So again, condos are a great way to live. They're a great place to live. It's just the guidelines on traditional home loans have changed. And so if you're looking at a condo out there, the takeaway is don't wait until you're under contract to do all the research that we need to do up front to make sure that that condo is either good or it's not good. If it's good, you can get a traditional loan. If it's not good or doesn't meet the requirements, you can still get a non-traditional, non-amortizable condo loan. It's just a little bit higher of an interest rate, and obviously it requires a little bit more money down, but all condos are still gettable and doable. The takeaway is just do the homework up front to figure out exactly which program and product you're going to end up taking based on the details and the research and the answers that we get back from the HOA. So listen, I hope you found this video useful. If you did, do me a favor, share with somebody that you know that could benefit from this information. Any questions you got, drop a comment below, like, share, subscribe. If you're just looking to have some questions around your pre-approval, your journey, how to buy a house, next steps, any questions at all, do us a favor, reach out to us. Call us, email us, text us. We're always here for you. Until next time, stay tuned.